One stat we're watching this morning, though, gas prices falling nationwide. Those lower averages mean more money in people's pockets, and with their ubiquity and attractive prices, it's quick service and fast casual restaurants that stand to gain. Here with more, we've got Jon Tower, Citi Research U.S. Leisure Analyst. Okay, is the leisure play starting to get a little bit more attractive here as gas prices fall?
Yeah, look, we've been on this for a while now. We wrote in early June that you should never short the American appetite. And frankly, that's continued. The demand data that we can look at, whether it's industry-wide metrics from some of the brands that, or some of the companies that track it, as well as some of the numbers we got during 2Q reporting season, suggest that the consumer still is eating out, eating away from home. There was a slight blip during the month of June, really late May, early June. But generally speaking, the consumer continues to eat away from home. And now that we're seeing some of the gas prices roll over, that acute pinch that many, particularly the lower income consumers, felt in late May, early June, are starting to see a bit of a turnaround. So, even measuring it by different methods, looking at, we dig into the CPI report and overlay that with some of the consumer expenditure survey work by income brackets. And really, only the lowest income consumer is feeling the great pinch from inflation. And that is now reversing with some of the most recent reports on CPI, and obviously energy prices being a big component of that. So we think there's a very good play here going forward in the back half of 22 and into early 23 for the restaurant space.
John, we're by and large through restaurant reporting season. What names are impressing you? Because there are names out there, I imagine, that are not in the same boat as a Sweetgreen. That was a tough quarter from them yesterday.
Well, Sweetgreen, they have a unique situation, right? They're over-indexed to deep urban markets, and frankly, they're feeling essentially the pinch of consumers working away from home. And especially since the Memorial Day holiday, a lot of, workers that have traditionally been in the city have pivoted to, summer homes, or frankly, away from the city as much as they can. So I think that's a bit unique to that brand, given that they have that over-index to the urban markets. The rest of the industry is doing quite well. And to be fair to Sweetgreen, their numbers are still pretty good in absolute. It just didn't necessarily measure up to expectations internally and externally. Looking at the rest of the space, numbers were pretty darn good across the board. And we're still big fans of what Yum's putting up, what Yum, Domino's had put up. We're looking across the rest of the space. Wingstop had a very good outlook. They're putting out a new chicken sandwich hitting early September. They've expanded 3 PD partnerships, so onto Uber Eats now. They were solely DoorDash before, and that should provide a nice tailwind to sales. And they're going to be out there marketing a lot more in traditional media than previously. So that's an interesting brand to continue to look at. Chipotle had a very good quarter. They're going to be taking more price, and the margin side of the equation was not nearly as bad as I think some investors had feared. So there's still a decent, setup for these brands going into the back half, particularly now with a lot of the food input prices rolling over. If you look at one of the key benchmarks, AeroStream, the actual year-to-date index that they track of key input prices for the restaurant industry is now down, and it's off 20% plus from its peak, but down on a year-to-date basis as well. So with all the pricing that a lot of these restaurant concepts have actually taken year-to-date and actually into the third quarter, and some of these inputs starting to roll, there's a good case that the back half, particularly the fourth quarter and maybe even early 2023, margins could really expand, assuming demand doesn't roll over. And we're not seeing any indication that that's going to take place.
I want to stay on Chipotle for a hot second there, since you brought that up, because, this is a stock that we've seen move higher by about 29% over the past month. You mentioned earnings and some of the tailwinds that the company can ride, not to mention this mix between the type of consumer profile that they can go after, both in a down or kind of a down period for consumer sentiment or an up period for consumer sentiment. And so when you think about the customer profile and how that also translates into some of their competition, is Chipotle kind of in this moat type of scenario with regard to how they are able to fend off perhaps not just competition, but the inflationary or even a deflationary environment?
Yeah, look, they skew higher income relative to your traditional quick service restaurant concept. I believe it's north of 60% of their customers are making or part of households with incomes greater than $75,000 a year. So that helps in this type of a backdrop. But on top of it, I think they're pushing aggressively on some levers that the rest of the industry's already played out. Specifically, when you think about marketing, they're still early days of building that budget, and it grows every year with their sales, given the fact that their store base is still growing. On top of that, I think a very important piece is they've got a digital platform and a loyalty program that's still early days and growing. And it's frankly an ongoing communication tool with their core customer who's generally a little bit more tech savvy than, say, some of the larger restaurant concepts in the U.S. So that's a one-to-one communication tool that wasn't in place, 5-10 years ago, that allows them to, say, incent visits and change consumer behaviors more easily than perhaps some of their competitors have. But look, everybody in the space has gone after it. I think the leader in the category is Starbucks. They've done a phenomenal job more recently with the Star Dash program in terms of incenting consumers to come more frequently, change their habits when they come there, whether that's adding on a food item or trying a beverage that they wouldn't have done, or even perhaps trying a different store if there's some sort of operational issues going on at an existing store. You provide, these stars in the Star Dash program to incent visits to different locations. And, I think a lot of these concepts have done much better job of using loyalty and technology to do communication with direct customers and frankly, keep the frequency high, even when times get tough.
Well, John, a quick little note for me, for your various notes. I just paid $8 for Starbucks iced coffee. I was blown away. But we'll take this offline. Citi Restaurant Analyst Jon Tower, always good to see you. I'll talk to you soon.